I think it is 11 o'clock and we can get going. So, good morning, everybody. Good to be back. Uh, Different sort of format this time. So, I've got some news, Richard's got some news. But the big thing, obviously, is we're going to tell you who the winners are of the Investors' Choice Awards. It's all very exciting. And to talk us through that, what we've done is we said, let's bring on the whole analyst team. So it's going to be sort of me and Richard and Matthew Reed, who you know from doing the show last week, and also David Batchelor, who's one of our newer recruits. So the four of us will be talking about the results as they come through. Please do ask questions as we go. Put them into the YouTube chat box as normal. And we're also going to tell you who won the £5,000 prize for predicting the results. So, without further ado, here's some news. So, two things for me, European small caps and Bellevue Healthcare, and then I'm going to hand over to Richard. I'm going to talk about European smaller companies, European assets merger first. So post merger now, this has got a market cap of 477 million. The discount's still a little bit too wide, but these are small caps, and small cap trusts do tend to trade on slightly wider discounts than large cap trusts because of the liquidity of the portfolio, and that's all fairly reasonable. And so driving it down much beyond that is not, well, it's probably just sort of wasting time, really. The yield on this is going up, and this is one of the things they've done as part of the merger. So it's 2.3 looking historically, but that's going up to about 5.5% as things stand. So European Small Companies Trust is issuing 131 million shares, and they work out what the values of the two NAVs are, and then just do the exchange based on that, so nobody gets diluted. There was a 15% cash exit available for European asset shareholders, and that was sort of twice oversubscribed. So 30% of holders said we'd like cash, please, and obviously that means there may be some frustrated sellers. Now, I wouldn't necessarily say that's the whole 23.6 million shares, because obviously some people will go, oh, if I can get out asset value, great, I'll do that, and then maybe I'll buy them back or something. Like, if I can't, doesn't matter. So there may be something like that, because obviously you could have got out asset value through that exit, but instead this time around, you're now selling the market. So will people just stick with it instead? And I think there are good reasons why they should stick with it, really. So firstly, the combined trust, the newly enlarged trust, is going to be using buybacks to try and keep that discount sensible, so which is good. There is also a performance related tender offer, which is going to happen every 3 years. It's not very big, to be fair, but it is there, and that's another sort of little tick in the box. And also we're getting this much higher dividend, which I think that's going to be really helpful. And there are other things. Well, we went through the detail of the merger when it was all announced, so there's other things like lower fees as well. But the killer really is the performance. This has been a very good performing trust, and that's carried on going this year. It was one of the reasons why we were slightly flabbergasted. Good word from traders if you're watching that. Why European smaller companies was targeted by Saba. It didn't really make sense. But I think the fact that this seems to be carrying on going, and the fact that we've also got this steady idea of people looking, are there places I can put my money instead of the US, because I've got a lot of money in the US? That sort of broadening out investment portfolios is kind of happening now. And I think Europe and European small caps could carry on going for a while yet. They're not really looking expensive. Bellevue Healthcare is sort of the other thing. So we've really not particularly good performance. So you can see there, and a discount that was too wide. And then they announced that they were going to do a zero discount control mechanism, and that sort of put the discount out. But the problem is, obviously, if you look at those returns, they are by far the worst in the sector. Over 1 year, over 3 and 5 years, they're pretty bad too. And only Citizen Cone is worse over 3 years, and we know that's winding up as well. So I say as well, we'll go to that in a second. And there's quite a big gap between things like Bellevue and Polycap Healthcare and Worldwide Healthcare, which are the two closest competitors. Part of the thing that's been going on, we were saying for ages, biotech's really out of favour, everybody hates it. There's just a general sentiment was really against it. That's changed very dramatically in the last couple of months. And that's really been driven by M&A. And there's a whole long list there of takeovers that happen in the biotech sector. And it's mostly big pharma companies with cash rich, maybe patent expiries coming up, looking to renew their portfolios. And they're buying in companies and products that actually look quite exciting to them, so that might drive their growth going forward. And they're paying up for those. So they're actually paying really quite big premiums. And so there's quite a lot there. You'll see IBT's name come up quite a lot, RTW's name come up quite a lot. Biotech growth, well, that's been performing very well. Only mentioned once there. They're not being particularly good at telling us what's in the portfolio, unfortunately. And IBT and RTW will announce when these things happen, and some of the other ones won't do that. Worldwide Healthcare, I couldn't see it owning any of these. Polycap has got Merus, or did have, so that's helped it. So, but the name that's not on there is Bellevue Healthcare, and it's kind of missed out on all of this. And this is one of the reasons why it's really lagging behind. So what they've done is they've called an EGM to ask for more buybacks, and because obviously they need to keep renewing the facility to do that. But since they introduced the zero discount control mechanism, they've already bought back more than half the company. This is in just since 23rd of April. And that sort of depth of feeling of I don't want this anymore is so strong that you have to reckon that this is just going to keep going. And at some point, the trust won't be viable. And at some point, it'll be so small that nobody's going to want to even bother taking it over. And really, I don't think the problem is the discount. The problem is the performance. And so my inclination would be, if I was a shareholder, to vote against this approval and force the issue and get them to do something about who's running the company and how it's run. I think that is what really has to happen now. And shrinking it further just won't make much of a difference. So that's enough from me. I'm going to hand over to Richard.
Thanks, James. Yeah, so busy week for Blackstone this week. So as we'll come on to a bit later, but first of all, on Big Yellow, which is a self-storage fund. So Blackstone came out earlier this week saying that it's considering an offer for the company, and the shares leapt after that about 15%. So it's now valued at about 2.2 billion, so still quite far below its net asset value of 2.7. But interestingly, in the Blackstone announcement, they said they're going to wait on the UK budget to see if there's anything in there that will affect its decision on whether to put an offer in for Big Yellow and affect the self-storage sector. But by announcing it this week, it's got till the 10th of November to make its intentions known on whether it's going to make a bid or not. And obviously the budget's at the end of November, so that's likely to get extended. Otherwise, that makes no sense. So if we look at Big Yellow's portfolio, it's on the next slide. Yeah, so this is why the budget is such a big deal for Blackstone, because the large majority of Big Yellow's self-storage portfolio and the self-storage sector in general is driven by the residential market and how strong that is, how often people are moving or downsizing. So as you see there, 26% is from use of people when they're moving home. And then another sort of 15% is from the rental sector. So obviously smaller flats and apartments don't have the storage space of houses, stuff like that. And only 11% is business use, which is quite on the smaller side. So smaller businesses using it as storage or maybe even e-commerce type uses. So there's been a lot of rumours and about the budget and what's going to come up in it and what taxes are going to change there. So stamp duty is likely to be changed in some format. Council tax bands as well has been sort of mooted. So all this would have a bigger impact on the residential market, house moving market, and things like that. So that's exactly why they're waiting. It could be a good thing. They might stimulate the market and get people buying and selling again, which would be a great thing for self-storage market. So we'll wait and see on that. We look at the next slide then. So the self-storage sector is still relatively nascent in this country and in Europe actually, compared to the US. Big Yellow is the largest operator in the UK. So it's got just over 100 stores, a bit of development in there as well, but its occupancy is at just below 80%. So that may be something that Blackstone's sort of looking at and seeing that it could push up. It gets just over 200 million in annual revenues, which has gone up 3%, as has the rent that they're charging on this. And the portfolio's valued at about 3 billion, which is on a discounted cash flow basis. So that again, that's something that sort of Blackstone are probably looking at to see that the future sort of cash flow opportunities there that they can push on and make some money here. So there was a deal last year for Lock and Store, which was a lot smaller listed company, and that went at a hefty premium to its net asset value. I'm not sure this would be at that level, but like I said earlier, it's even with the big sort of spike this week, its market cap is still well below its net asset value. So I think there's probably some more for it to go there if an offer did come in. So all eyes on the budget in a few weeks' time on that one. The next story is Tritax Big Box. So it's actually where the NAV fell off a cliff there. That's obviously when interest rates spiked and things like that. But it's done a good job of sort of stabilizing that, and you see there that towards the end that that's come up again now. So they're doing a good job of growing sort of values and things like that. But its discount is still massive, sort of 24%. And it announced this week that it's acquiring just over 1 billion portfolio from Blackstone. And if you remember, Blackstone won out in their bid to buy Warehouse REIT against Tritax Big Box. So Big Box are sort of known for their dealers, basically. So you can see this was going on in the background probably at that time. So the structured deal, they're going to get a new debt facility in place to pay cash to Blackstone, about 630 million, and then they're going to issue 375 million of shares to Blackstone, which will then own almost 9% of Big Box. And the issue price was at 161, which was a nice premium to the share price the day before, but also a sort of bit of a discount to NAV. So the portfolio is 9 sort of big box distribution warehouses and also 32 smaller urban logistics assets. So this is Big Box has sort of been diversifying into the smaller end of the market, and so they've got a sort of more rounded portfolio. So they're not so reliant on single let big boxes, which are sort of less liquid than the smaller end of the market. So it's 6.5 million square feet, 95% let. The reversion in this portfolio is pretty good as well. So it currently gets 53 million. There's the potential for it to get 67 million on today's sort of rates. So that's a 28% reversion potential, bringing the yield up to 6.4%. So they'll be looking to move that along pretty quickly. They're saying it will add 5% to earnings in the first year and then be meaningfully accretive in the following years. And they expect to capture about 80% of that rental reversion before the end of 2028. So And another interesting point in the deal as well, there was a reversion bridge that they've sort of negotiated with Blackstone. So Blackstone will pay them 20 million over 3 years to sort of guarantee that some of that reversion in that period as well, which is interesting. So the debt facility they've agreed with Santander. It's not been put in place yet, but it will soon be. So 650, which is huge. It's only a 12-month term though, so they'll be looking to sell some assets and pay this down pretty quickly, because although the margin above Sonia's 0.8, which is very competitive, obviously Sonia's quite high, and the cost of debt will rise to 3.6% from its current 3.2 for the company as a whole. So they've said they're going to look to sell 300 million of selected assets within its portfolio over the next 12 to 18 months. That's on top of, it's already announced and identified other sales that it wants to do of between 250 and 350 million, and they'll use that to sort of pay off the debt and bring the LTV back down to sort of the low 30s. And then just looking at sort of Blackstone's strategy, really. So it looks like they put a bob each way, really, on this. So if the shares go up, then obviously they get to profit from that. They've got a lock-up period to the end of 2026 before they can sell their shares. So it's a win for them if the shares go up, which I expect it to. We're coming off the bottom of the market. Hopefully, sort of macro improves for the property sector. But if they don't, if they continue to trade at this massively wide discount, they could launch a takeover bid for Blackstone. That couldn't be out the sort of realms of possibilities. They've got a standstill period in place till 2027, so that could happen. And also, they've got, I mean, they're one of the biggest real estate investors in the world, and their big bet is on logistics still. And you might remember that they've bought Industrials REIT a couple of years ago, St Mod Wind as well. That sort of repackaged company is called Endurant, and at some point they will want to sort of exit that and be a private equity firm, and there has been rumours that would look to list that at some point. So that could be another avenue where they sort of merge that with big box later in the future. But this is me just just looking ahead. But what really strikes me right now is that one of the largest real estate investors in the world is buying big box at a massive premium to their share price of 13.5%, and there was no real reaction to the share price on that. So that was a strange thing. Surely that's got to change, and but we will wait and see. So that's all from us. There's the legal bit. You can look at that in your own time. But now we're going to get on to the awards and announce the winners and have a discussion about who's been nominated and who's been doing well this year. So
Brilliant.
everyone's back in the room now. Hand over back to James.
Thank you very much, Richard. Big box is very interesting, I think. Yeah, I wrote something about this the other day. I do think it's one of the other things that gets me is obviously they're going to sell that stuff down. They were talking about funding data centers from those sales as well. So they don't know, they might need to find some more money other than that, but we'll see how we go. Right, now, without further ado, we've got a whole list of categories to run through, and I'm going to start with the best global trust. And we had 4 nominees here. You can read them on the screen. They're sort of all quite different, I think. I'm willing to be interrupted and by my colleagues here, and they can argue with me about this. But JP Morgan Global Growth and Income is a global trust looking at sort of growthy type situations and manufacturing the income by out of capital. And so it's got quite a big exposure to things like Magnificent Seven and that sort of stuff. AVI Global is very different because it's more of an activist fund. It's got stuff in Japan. It's got stuff in holding companies. It's got things in private equity stakes, listed private equity stakes here. I mean, there's a whole mix of different things in that portfolio. So it is quite different. My International is an old-fashioned, if you like, but I don't think I really like that word, but it's a income fund, but actually trying to generate the income itself. And because it's doing that, it's got a bias away from the US, which is interesting in a situation where everybody's a bit worried about what the US is doing. And then we've got Alliance Witan, which obviously everybody should know very well because we've had them on the show quite a bit with the chaps from Melissa Watson, and also because we write notes on it as we do with API Global, and it's got this sort of manager of managers, 20 best ideas thing, which is very different again. So they are an interesting bunch of trusts that the panel came up with. And remember, these all of these things, we had a panel completely independent of us that picked the shortlist, and all of the winners have been selected by you, the viewers, you, the readers. We haven't touched this at all. So this is, I'm not saying we don't agree with it, but yeah, this is just our neutral observations on decisions that other people have made.
Yeah, no, I think that kind of reflects the strength of the process, because I look at all of these and I really agree. I think they are all quite different, but I like them all. You're probably going to hear me say that quite a bit today, having sort of run through the list. But I'd quite happily own a mix of these because they're all doing something a bit different. When you look at sort of JGGI, that seems to be, if you're a sort of large global fund, or it is a large global fund, but if you're a smaller global fund, maybe you've got a few issues. It seems to have become the sort of merger partner of choice. It's absorbed a couple of funds from sort of JP Morgan. I think Mate went in there in JP Morgan Elect, but it also had sort of Scottish Investment Trust a while back, and it sort of more recently had HIT. And there are some really good reasons why it's sort of achieved that. Obviously, it's large and it's liquid, but as they've sort of grown, they've quite rightly shared the benefits of that scale by sort of pulling down the fees, shared those with shareholders. So you can see why sort of people like it. And, I think strong performance track record, you can see why that one's in the list.
Talking about mergers, Matt, Alliance Witan, I mean, that seems to have gone well. I mean, it's old news really now, but that all seems to have worked out for shareholders.
Yeah, I mean, that's now like a sort of nearly £5 billion market cap fund. And once again, I mean, because it's fees, I did look, they're slightly higher than JGGI, but there's really, a matter of bips in it. But once again, they shared the benefits, didn't they? They brought the management fee down on that. And that's, I mean, I really like this 20 best ideas. Obviously, you've got these sort of 10 or 11 managers. So you sort of get the diversification that way, but they're all best ideas portfolios. And this is why I think, it sort of kind of delivers over the longer term. But the other thing with that is that it sort of defends this 5% discount, which gives you quite good certainty as well. So you can sort of see why that appeals to people.
Good stuff. Right, should we find out who the winner was?
Yeah, go on.
Drum roll.
Ta-da. JP Morgan Global Growth and Income. So congratulations to that. And our next category is
best for small cap. Okay, so the sort of nominees were Rockwood Strategic, European Smaller Companies Trust, Scottish Oriental Smaller Companies, and Nippon Active Value. And I think sort of once again, these are all funds that I like, but they're actually very, very different. Once again, I think you could make a case depending on sort of your risk preferences, etc., for having a chunk of all of these, because you've basically Rockwood's predominantly UK. I think it can hold Europe as well, but it tends to be predominantly UK. Then obviously, you've got Europe, you've got sort of Asia, ex-Japan, and then obviously, you've got Japan as well. So you've got a sort of real mix of stuff in there. As I say, we don't know who the winner is yet, but I think the interesting thing about all of these is they are all in spaces that sort of tend to have less research coverage. So sort of not only may you get the sort of value in the growth of the underlying, but actually these guys are sort of targeting at times things that are potentially sort of quite unloved. And so you can get really good kickers from all of it. Equally, I think you can find that the returns are quite lumpy, which you sort of need to take into account. But I think, that's sort of a theme across all of them. So I like the sort of Rockwood fund. I think they deliberately keep that quite small to keep that agile, and that sort of seems to work. And it's got this kind of private equity in public markets approach where they're sort of looking at things from the perspective of a sort of trade buyer, or sort of private equity or a strategic buyer, which is sort of perhaps different to the sort of multiples you tend to see applied elsewhere. So that has tended to sort of work quite well. European smaller companies, I mean, that's obviously really interesting because that was one of the Saba targets. And that's just absorbed European assets trust. So you flip that and you go, well, clearly it must have been doing something right. And I think certainly some of these spaces are quite unloved. And the whole sort of Saba thing showed that they were applying things that were sort of structurally quite out of favour. Of course, Europe has since had quite a sort of significant bounce. I mean, once again, Scottish Oriental, that's been around a long time, sort of very good process there. Small cap Asia, once again, as we know, there's a lot of stocks there and actually disproportionately low coverage. So, it's a great place for sort of active managers to sort of add value. And Nippon Active Value, once again, we know the sort of themes that's exploiting, corporate governance in Japan, etc. Just another good fun. Anybody else got any thoughts? Because I'm sort of dominating the airwaves here.
Well, I think the main message is actually globally, small caps been out of favour because there's been this sort of obsession with what's going on with the big mega cap tops in the States and the big AI themed ones. And small cap has kind of suffered by comparison. So a lot of people have been taking money out of these things and putting them into the big stuff, or going into tracker funds, which don't necessarily have the same sort of exposure to lots of small caps because they kind of cut off too soon. So I think, there's value, and that makes it interesting. So even though these things have done very well, doesn't mean that there isn't more upside.
They're going to have a moment, aren't they? And you don't want to be the other side of that when that moment comes.
Yeah, exactly.
Yeah, absolutely.
Should we find out the winner?
Here, Rockwood is great.
Yeah.
On, let's see who won. And they did win.
It is right. There you go.
Rockwood Strategic. There we go. Honestly, they are the class act. In that sort of activist UK bit.
As I say, the sort of private equity and public markets slant really adds something with that. They're not the only ones that do it, but clearly I think that shifts the dial here.
Very good. Next.
Thank you. Yes. So number 3 is best country or regional. We've got Ashoka India Equity, JP Morgan American, BlackRock Frontiers, and once again Nippon Active Value Fund. So the second time we've seen them, and I think JP Morgan American also a multi nominee. I think we'll see them again later. Clearly, almost by definition, these are quite different. They look at different parts of the world. Nippon Active, which, as I say, we've seen in the last category as well, is particularly interesting. I think Japan has really been in focus the last few years for this corporate reform agenda that the government has been so big on pushing. Traditionally, a country where it's been difficult to be an overseas shareholder or a shareholder of any kind, really. But we've seen some really meaningful corporate reforms in that country, and the fund has been able to take advantage of that, to work with boards to drive through change for shareholders. So I really like sort of what they're doing there, and I think it's a classic case of they're doing something which you as a private investor would really struggle to get meaningful exposure to yourself, or certainly knowledgeable exposure. Japanese small cap, not something most of us know much about, so you really are paying for real expertise there. I really like what they're doing. BlackRock. Sorry, do jump in.
Well, I was going to say you could say the same of the Ashoka and the BlackRock Frontiers Fund as well.
Yeah. Although with the way the sort of Nippon funds, etc., the way they're sort of trying to add value, it helps if you can actually apply some scale to the problem. And I think there's an extra argument there for actually having that leverage. So yeah.
Ashoka India, probably worth saying that the fee set up there is quite unusual and quite attractive. They don't charge a management fee at all to investors. They just take the performance fee. I think it's 30% of outperformance. So that's quite unusual, and I think quite attractive to shareholders.
I'd also like to sort of highlight JP Morgan American, just because it's really hard to beat the US market at the moment because we've got this big mega cap thing. And there are other companies that outperform the likes of Amazon and Microsoft and stuff. But because there's such big weights in the index, trying to actually beat that index is a hard thing to do. And they've got this sort of structure where they've got growth and value elements to the portfolio and a small cap element, and they've been able to blend that really quite well. So I do like what they're doing.
I think that's a really good point. They've outperformed the S&P 500 over 3, 5, and 10 years, which is really quite good going. I think I saw a stat that across all vehicles in US large cap, it's only 17% of active managers outperform the index. So really quite good going there.
Cool. So no questions on this one. So let's move to the winner.
The winner.
The winner is.
I was singing their praises, and it's Nippon Active Value.
Yeah.
I think very well deserved.
Cool. Okay, next.
Okay, next category is Best Sector Specialist. And again, it's a sort of diverse bunch. So we've got Polar Capital Global Financials, CVC Income and Growth, CQS New City High Yield, and BH Macro. So what do people think?
These are a great set of funds, to be honest. I like them all, and I can sort of see sort of place in. Yeah, you can make an argument for all of them, basically. James might want to jump in on Polar Capital Financials because
I was going to actually go straight to the bottom. I've always had a bit of a problem with BH Macro, not because they're not a good fund, but because there's no way of knowing what's going on underneath it.
That is fair comment. That is difficult.
And so it's very much
obscure.
like, taking a leap of faith, trust them that they know what they're doing. And obviously, the numbers suggest that they do, but I wouldn't have a clue. Like if the dollar just dived tomorrow, would they go up or would they go down? I honestly wouldn't know.
It does feel like what would happen is whatever the black box said.
Exactly.
I would agree with that. I would agree that you'd certainly get better transparency with the others, that's for sure. But once again, they're all quite difficult, aren't they? Yeah.
If we're going up the list, you're the New City High Yield expert, Matt.
Yeah. And I am unashamedly a fan of that. I think, it is differentiated versus its peers. It sort of does a sort of very specific thing. It does invest in high yield securities, but it does it very, very well. And they've sort of got the expertise to be able to look at things that are unrated, and they can effectively apply their unrating to them, so they can get a sort of decent yield premium for that. And the whole thing is very, very sort of shareholder friendly. They sort of grow it in a very measured way. I mean, reflecting the yield that this thing pushes off, there is strong demand. It just consistently trades at a premium, but they're sort of very careful that they don't dilute existing shareholders. They just grow the whole thing in a measured way. So, you don't get into that unless you're paying sort of 5% premium, because they're making sure they're covering the issuance cost, and they will only do it at certain times so that, they don't dilute the revenue reserves effectively for existing shareholders. But fundamentally, it just does what it says on the tin. I like it.
CVC is the interesting one, I think, because I didn't know an awful lot about it until I wrote a Citywire article about it a few weeks ago. And it was and I wrote that because they're actually issuing stock, and they've actually got the issue running now. So they're actually trying to do quite a big placing.
Yeah, I saw that.
So good luck to them for that. But it's fascinating because the portfolio, it's not sort of mainstream debt. There's a lot of companies that are challenged in one way or another. So there's a lot. So when you think about the credit ratings of the bonds that it holds, there's quite a lot that's rated down towards C, which is where you start getting below investment grade.
Yes.
Well, actually, that's actually quite hard than that, and even down into things that are really struggling. And it's the key there to performing is having really good credit analysis, and that team has obviously done a quite good job of that. And if we get more difficult economic environment, it's going to be interesting to see how they do navigate their way through that.
Yeah. And I think that having that sort of credit analysis is key, certainly if you're going to operate in the high yield space, being able to work out whether something is effectively mispriced because the rest of the market thinks that it's riskier than it is. That's where I think you can really add a lot of value.
And then PCFT, we know and love. I mean, again, we've had the managers on the show. We've written lots of notes about it. Financials has been a great place to be because of where interest rates were negligible, and now they went. And when they went up, banks suddenly made a lot more money. We haven't had a lot of loan defaults, which is one thing that's always benefited CVC income and growth. So that's helped profitability as well. And then there's all this other stuff going on with all the digitalization of stuff that just makes the whole business more efficient, use of AI. I mean, there's so much stuff that's helping the profitability of these things grow, that I do think financials has been quite a good place to be recently. And you've seen that in the UK bank stock prices. They've just gone, seen that. Right.
It's interesting, though, that you mentioned UK Bank, because I mean, this thing was set up to provide an alternative, because so many people just went directly and said, okay, we can do this globally and we can do it in a sort of diversified way. And if you look at that sort of versus holding a broad basket of UK banks, I mean, clearly it's been a great place to be.
Cool. Should we tell you one?
Yeah, go
on. Very good. CFC. Very good. Very good. Cool. Next. Best UK. So we've got Rockwood again. And well, obviously well deserved. One last time. We've also got Temple Bar, which again people should know because we've been writing about that one, and it's a different sashi again. It's value. Fidelity Special Values. We do like them as well. And Edinburgh Investment Trust, which has changed managers quite a few times while I've been around, but seems to settle down now where it is and doing okay. Anybody want to jump in? And
well, we've been through sort of Rockwood to sort of quite some detail. Once again, this sort of private equity and public markets approach, which has added a lot of value. I mean, Temple Bar, as you say, is differentiated by its value approach. I mean, these guys are unashamedly deep value, but with the way interest rates have moved,
they've done very well out of the UK banks.
Yeah.
Although I would say that they make a point that yes, they're deep value, but they're not investing in rubbish. They still have to fundamentally believe that the companies have got a decent story. Sort of the likes of M&S is a good example. It was deep value, but has had a fantastic turnaround. And
no, the key to investing in deep value is still being able to avoid the value traps, isn't it?
Quite right.
They've been effective. They've been effective at doing that. And certainly, if you were looking for a value trust, it is a great place to go. And for similar reasons, I've always liked Fidelity Special Values. I mean, Alex Wright long had exposure to the banks, taking the view quite rightly that actually in the post-global financial crisis world that they changed, but really the market wasn't giving them credit for that. And you can see, Temple Bar and Fidelity Special Values have benefited that as they've obviously come back strongly.
And obviously, the other thing is, and we're talking about it small cap, but it's definitely true of the UK. Here's a market that's very much out of favour, very undervalued relative to the rest of the world. Yeah. And all of these things, although they've done well, there's an awful lot more room for them to go further. Absolutely.
If you look at versus where they are, and how these things are still, despite sort of popping a bit, are heavily derated. There's a long way to go with these.
Yeah,
certainly potentially.
Also, if you remember, I picked Temple Bar as my stock of the year at the beginning of the year.
Very good.
So there we go. Cool. All right, see you won.
Yeah.
Yay! There we go.
There it is. Well deserved.
Cool.
Well done, James.
I guess let's just hope that the budget provides some decent news for the UK as a whole, and
yeah, exactly. That would
I think the macro position will improve.
Exactly.
Yeah.
So
okay, yeah.
Is that you, Matt? I think.
Oh no, I thought I was best alternative income.
Go on then, David. You do this one then.
Oh right, okay.
Sorry,
okay. Well,
we got lost in translation.
It doesn't matter. It doesn't matter. Right. So best for alternative assets for growth. So yes, we've got HG Capital Trust, Oakley Capital Investments, Columbia Threadneedle Private Equity Trust, and ICG Enterprise Trust. Who wants to dive in on any of those?
Well, I'll say it again. These are all strong funds. Bit of some differences, but these are all strong funds in their own right. I mean, I recently wrote a comment for a sort of journalist that just pointed out the kind of value that this is sitting there in private equity funds. I mean, HG Capital, it doesn't seem to go by without it making some sort of interesting announcement about something that it's sold and made a sort of decent realization. And it's not surprising that tends to trade at a tighter discount than its peers. But the thing that I sort of said to this journalist who was asking, if you look at some of the other returns that have been generated in that space, they're not far, or in some cases even exceed sort of HGs. And but they're trading at sort of colossal discounts. I think ICG Enterprise is something, if you look at its discount versus its track record, it just looks underrated to me. And similarly, you look at sort of some of the stories and some of the sort of realizations that Oakley's made. Once again, actually, it looks very, very strong. But that, for whatever reason, doesn't sort of seem to be reflected in its discount. Although obviously it's had the shift to the sort of main market, so hopefully it's going to catch up now. But yeah.
When do we think discounts will come in? Because, like you said, realizations have been strong in the last year or few months or so.
They're picking up, Richard, but there's still a way to go, I think. I mean, when you get the realizations, because this is what we were talking about in the news this morning, because Oakley's just sold something else, isn't it? And HG's just sold something. So I think Oakley sold something yesterday. It's about 30% premium, something like that, to the valuation. And HG sold something today for almost twice what it was valued at in the NAV.
Yeah.
And my point this morning was, all of these NAVs are really quite conservative.
Yeah, I was about to make that,
especially because when they're investing through limited partnership vehicles, which a lot of them do, there's no incentive for the general partners of these vehicles, the underlying managers, to write the values up, because they don't get paid on unrealized profits. They only get paid when they actually sell something.
And that's a common misconception, isn't it? This is the thing. So there's a lot of latent value sitting in some of these things. You see the sort of sales come through, and consistently they're above where they are, which makes the sort of discount to NAV look even more ridiculous if you think that there's additional value locked away.
Yeah. I mean, for a long time, you already mentioned it, but Oakley Capital, because it was on the specialist funds segment, a lot of retail investors couldn't buy it. But its returns are as good as, or if not better than, HG's over those time periods. I do think those discounts should converge. And it kind of goes for the others too. I mean, there's a long list of private equity trusts. There's some that I like that are on this list. There's some that I like on this list.
Yeah.
But generally, the whole sector is out of favour for no good reason.
Yeah.
And I do think that we've got a sort of steady flow of announcements of disposals starting to come through now. We need markets to be more stable. I think a lot more would have happened if we hadn't had the whole Trump-related tariff crash. In April.
I think so.
Because it was all kind of building towards something before that all started. So I think it's just pent-up demand. It'll happen.
But I think you're right. There's plenty of value, certainly in the private equity space, and there's plenty of other good funds that didn't quite make this list.
Yeah. Honestly, I don't know which one was one. So let's have a look. Oakley Capital. Very good. Very good.
Okay. Well deserved.
Okay.
All right. So it's probably
this is definitely you then. Matt.
This is definitely me, because I've stuck my hand up for it. So once again, actually some really interesting funds here, and sort of funds that I like, which, as I hark back, I think it reflects, even though we're independent, it reflects the sort of strength of the process. But I mean, 3i Infrastructure, it's almost a household name. Let's say all of these have something sort of different to offer, but this, I think, has got a sort of really, or particularly high quality portfolio of infrastructure sort of assets. It's the kind of thing that society just needs. You've got energy transition in there, you've got metro systems, digital infrastructure assets, the sort of whole shooting match. I think the key thing is they've done a decent job of managing these as well. As I say, pretty decent yield, just shy of 4%. And it's a pretty tight discount when you consider where some of these things have been trading at, about sort of 8%. So I could see why that's made the list. I think we like that. 24 Income Fund, this is a portfolio of UK and sort of European asset-backed securities. These are kind of things that, not surprisingly, are less liquid, but they're sort of high yielding. It sort of targets 6% per annum dividend, and I think over the longer term, sort of 7 to 10% per annum total return, which it's delivered on. I think it's quite a solid bit of ballast in the portfolio, because I think 50% is supposed to be investment grade. And obviously it's been exposed to rising interest rates, like some of the other things, that we've been talking about. It's also got this 3 years redemption opportunity that makes it sort of quite popular. We've sort of talked about that already, but I think this was the first wind fund. And I think it's the largest wind fund. And I think once again, it's really good at managing its assets. They've done a very good job of that. But like the rest of the renewable energy funds, it's been deeply out of favour as sort of interest rates have risen. I did have a quick look at this morning. 24% discount, 9.4% yield. You can see sort of why it sort of made the list with sort of yields like that. But I think probably what has weighed on people's minds is just low wind speeds recently, which is something we've discussed. But I just think this is still very, very predictable income, and it's still a sort of strong proposition at 24% discount. To me, that's pricing in a sort of lot of bad news, and I think maybe, as we've discussed elsewhere, there may be sort of upside in power prices. So that's equally quite interesting. Biopharma credit, I think we all really like that. That's sort of very unique proposition.
Yeah, I bought some the other day.
Did you?
Because
you've been thinking about it.
I did write about it in Citywire, so I told people I was going to do it. I do try and do that. And I did explain in that article why, but they had a very good track record of picking things that work out quite well.
Yeah.
And the beauty of it is when they have these deals, when stuff gets repaid early for whatever reason,
they really benefit. Yeah,
they get really big uplifts because they basically have arrangements where they say, well, we lent you money for 3 years and you've paid it back after 1. You've still got to pay us the interest on the next 2 years and a payment for penalty for paying it back early, and it's all this stuff. And it's
insane. But this comes back to the point. It's a very very profitable segment, and certainly in the listed fund space, nobody else is doing this. But I think the yields that they're pulling off are very very strong. I think it's targeting a dividend yield of about 7% per annum, and I think total return. So with the sort of capital growth that you're talking about, 8 to 9%, and it's delivered on it, and it's differentiated. You can see a place for it.
The Morningstar and on our website, the yield is down to 7%, but almost every year it pays a special dividend on top of that. So the real yield you get is actually higher than that, and it's quite often double digit. So anyway, I thought I need a bit more income, so that's like a good thing to do.
Anybody else got any thoughts on these?
No, I think should we go to winner?
Come on, James. Show us who won.
It says that. Seems to go to sleep. There we go. 3 ounces. Very good.
Okay.
They won it last time, I think.
Did they? Oh well. I think once again, well deserved.
Yeah. Good. Next.
All right. Next, best for property. So we've got AEW UK REIT, Tritax Big Box REIT, Target Healthcare REIT, and TR Property Investment Trust. So all doing different things, all different sizes. So we start at the top. So AEW UK REIT is is a big fan of those guys, and so are a lot of retail investors. I think sort of 60% of their share registers retail. So probably attracted by the high yield. So it's paid 8p dividend every year, or pretty much every year of its 10-year life. And their team does work assets basically. They go sort of under what institutional investors would pay. So anything under sort of 20 million, 10 to 20 million, probably, maybe less than 10 million is their sweet spot, but above what a private investor could buy. So it's and they can really sort of identify really good assets in that price range, and then they work them they with asset management initiatives and things, and bring on the rents. And then what they really do well is sell well as well. So they buy well, they push on the rents, and they don't fall in love with the property or anything. They get rid of it as soon as they think they've done enough, done as much as they can on the rents, and then rinse and repeat, and they'll do that again, and they do it over and over. And this is why it's sort of topped the charts on performance over the last sort of 10 years. It is quite small though, sort of market cap around 200 million, and it is finding it difficult to grow.
I think it deserves to be bigger.
it definitely deserves to be bigger on performance. It's trading that close to NAV, and that's sort of in the property sector at the moment. It's
That's
probably
unheard of.
one of one. Yeah. So, but like I said, 60% retail on the share register makes it hard for them to sort of tap their investors for a lot of money, and then obviously the big institutions want to put a lot of money into allocations into property and stuff, and may not be able to do that, or this might not even appear on like they might not register this. It's so small.
Yeah,
So,
I wonder whether it could grow quickly, because given the lot sizes you're talking about, if it got a big chunk of cash, that presumably would take quite a while to deploy anyway.
Well, I think that's what I think. I spoke to a manager pretty recently, and they've got identified 100 million in their pipeline, which they can get straight away. But
because AEW is a huge manager, you forget about it with the size of the REIT, but
yeah, AEW is a massive name in the property world, and in Europe they're huge. Next on the list is Tritax Big Box, which I spoke about earlier. Another one that we really like. They're huge now. Been doing well in M&A in the last couple of years, and like I think I mentioned earlier, they set out again, I think just over 10 years ago, I think about 11 years ago they've been going, or 12 now actually, and they set out, as the name suggests, investing in big boxes, which is the single let massive warehouses let to the likes of Amazon and things like that. They've started to diversify and do some of the smaller urban logistics stuff where it's a lot more tenants in there, so just to sort of diversify that income, I suppose. And they've got a big development arm as well, which they push in a lot of capital into, and they can get higher yields on and returns on those. And they've, like I think James mentioned earlier as well, they've just gone into data center. That's a big push for them. So it'd be interesting to see what happens there and what happens with the deal with Blackstone and all that in the background. Target Healthcare REIT, they own care homes. They did have a peer care REIT, which got bought out at a big premium to the share price. That hasn't really been reflected in Target's share price that much. And the dynamics behind the care home sector is strong, as you can imagine. Sort of aging population, sort of what we do at the end of our lives. The only sort of slight question mark is around getting with sort of us leaving the EU and things like that. Is staffing at these facilities. But I did speak to manager, and they say that because they own sort of best in class care homes, that they're not having as much staffing issues as you would find at the sort of the sort of lower end of the market. So again, performance is done well there. Long leases, inflation linked, so they're doing well. And then TR Property is an investment trust of properties of REITs, and mainly Europe and UK. Well, fully Europe and UK, but mainly Europe. And their manager Marcus Fairmudge is sort of one of the top managers in the game. He knows his stuff, and their performance is doing well, but discount too wide, like I could say about most of the trusts. So
yeah,
I wouldn't want to pick a winner out of those, to be honest. I think they're all sort of deserving. I don't know if anyone else has any thoughts on these guys.
No, I like all of these. I think they've all got really sort of strong propositions. Then you say they're different. It's interesting you talk about the way that sort of Care REIT was snapped up, and you can see how this applies to big chunks of the sort of property sector. But you look at all of these, and they've all got an angle, and they all really sort of deliver well, and sort of a lot of undeserved discounts. I mean, I really like AEW. Particularly like that because I like the way, as you mentioned, they work the assets. And I think that's something. And plus, because you're going at that sort of size that's slightly below the sort of institutional grade for most people, you get that yield premium, and then they're really working the assets on top, and it's just reflected in the results. And it's little wonder that it is as popular and sort of trading that much closer to asset value. as a result. But they're sort of
I
working
think-
hard at it.
I think there's just been so much consolidation and M&A
Mm.
activity in this sector that I think we must be past the bottom of it now. I mean, you've seen that. I've already argued this before with the Tricentennial NAV going up.
Yeah.
It just feels to me like they think this has already turned, and the likes of Blackstone coming in and buying these assets on the cheap. They know what they're doing.
Yeah.
I wouldn't be surprised if we're not that far away from people, the investors catching up to this and going, actually, we've paid away too much of our property exposure and we need to get more back again. And actually things get relaunched, or things like AEW actually expanding. So that'd be really good to see. But we'll wait to see.
One,
Right, okay, we should who won?
Come on, who won?
Oh, cool.
Oh,
AEW
cool.
UK,
Okay.
very good. Very
Yeah.
good.
That'll be like
All
that.
right. Next on the list, best for income. Lord Venture, I think they won last year. Very well deserved, because obviously the beauty of that one is they've got this trustee business on the side, and that generates a lot of income, which means that they don't have to work so hard to generate the income from the equity portfolio, so they can invest in slightly lower yielding things, which means they don't get caught in that kind of value trap stuff. And James Henderson, Laura Fole, great managers. Yeah, tick, 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 tick. City of London's like an old stalwart, really, and it's got one. I think has it got the best track record of growing its dividend every year? It's up there if it isn't the best one. 24 Select, you already talked about before, and CQS New City, we already talked about before. Again, all of these well-deserved nominees, I think.
Yeah.
Anyone like to add anything to that?
Lord Venture, it's fascinating. Sorry.
It is. That is a fascinating structure.
You wouldn't set up a company like that now, would you? You wouldn't sort of from scratch say, right, we're going to have the professional services business alongside the more traditional trust, but it works. It works for them, and it churns out that income, like you say.
It adds a real ballast to the whole setup, doesn't it? Even if markets take a thump, that sort of professional services business they've got attached to it actually does well in those environments. So the income looks really solid, and if anything, it's throwing off cash flows that they can, add into depressed equities. It's a lovely combination, actually.
Cool. I think we should move on. If, that's all right. So the winner of this category is Lord Venture.
There we go.
Again, there we go. Next, Matthew Reid.
Oh, right. Oh, best capital growth. Okay, well, we've already covered Rockwood Strategic, and to a certain extent, Ashoka India Equity, although perhaps not in some as much detail. Perhaps we'll just talk about that separately. But starting with Ashoka, obviously, this is a fund. I'm just trying to think. It's not that old, is it? But it's experienced astronomical growth, I think, because it's got this very, very shareholder-friendly structure whereby, you're only paying a performance fee. There's no base management fee, and it keeps the sort of overall fees low, albeit they can be quite lumpy, because obviously when it does very well, the managers do well, because that's when they sort of get a fee. But it has sort of grown. I'm just trying to remember the multiple of it, but it's been very, very successful. Really like Vietnam Holding. That's one that we sort of ride on, and you've seen our notes on that. Experienced some sort of very strong performance, and the sort of great thing about that is that you're sort of set to benefit from this move from emerging market, or from frontier market to emerging market status, which has sort of half happened because FTSE have now moved Vietnam, which is the largest by some distance of frontier markets, to sort of emerging market status. So I think we're just waiting for MSCI to do that. The sort of foreign ownership limits has been really the big sticking point on that from a number of years, but that is finally coming through. And I think JP Morgan American, that's featured on our list already, hasn't it?
We've talked about that.
We've talked about that. So I think let's move on and see who won, because we're running out of time rapidly, aren't we?
Wait, you got a prediction?
Oh
no, let's just see. Let's just see. Oh, cool.
Right, okay. Yeah.
There we go.
Yeah.
Very good. Next.
Yes, so I'm talking about best board. So I think this was the one category that wasn't voted on, because it's a little bit more specialist.
There's a couple of those actually.
I beg your pardon. So one of a couple, bit more specialist. So the panel chose this, and so that is the winner, Greencoat UK Wind. So this is one of the first renewable energy companies to rebase their fees. So they're based not just on the NAV, but on the market cap as well. And that set the tone for much of the rest of the sector. So they were really pioneers in what is clearly a very shareholder-friendly move. They've been pretty good as well on buying back shares. So they did 80 million in 24, and they've promised to do 100 million this year. So, looking after shareholders as we would hope, and therefore the winners of the best board award.
Yeah,
Brilliant.
Quite a lot of boards followed suit, didn't they, with the fee structure?
Yeah,
that's
you
true.
said
Actually,
lots of different things. Yeah. There was a bit of a trend sensor. I think that's probably why the panel thought it was a good winner. Yeah. Cool. Next category.
So best large asset manager. So three big names there. So Aberdeen Investments, JP Morgan Asset Management, and Janus Henderson. Anyone want to wager?
Well, I should probably explain how this worked. So basically, what we said was, obviously, you can look at the performance of the trusts because that's a big reason why you'd like them or hate them. But the other thing is, how good are they at providing you with information? Like, are there fact sheets easy to understand? Are there annual reports easy to understand, and the right sort of length? And if you actually have a query, do they answer it? All that sort of stuff. And then also, to what extent have they been proactive about sorting out the problem children within their stable? So that was the kind of thinking. But should we see the winner was? JP Morgan.
Very good.
Very cool. Okay. And then because the big asset managers and the smaller ones, it's a different field. We had a best boutique as well. So
they all do good things. Don't ask me to choose. It's like being asked to choose between your children. Not going to do it.
Cool. So asset-backed investors, obviously you'll know them because of AVI Global and AVI Japan. And also now MyGo Opportunities that they took on. Harwood Capital is Christopher Mills and that lot. They just launched Achilles. Is the most recent thing. They're probably the most recent IPO in the whole sector. But they've also got North Atlantic Smallers and Odyssean and Oryx and so there's a bunch of them. White Oak, we've talked about quite a lot already. So Ashoka India and Ashoka White Oak Emerging Markets, and the three Polar Cap funds, financials and tech and healthcare. They've all been kind of leaders in their sectors. So you can see why all of these things move the shortest.
Yeah, absolutely.
Cool. And the winner of Best Boutique is Polar Capital.
Polar Capital.
Very good. All righty. Which treats us on to Person of the Year.
Person of the Year. Yes, I was going to talk about Heath Peter. Just realised I missed a trick here. We should have put a picture up of him. That would have been lovely. And then maybe, can you do? Oh, you've done it! Amazing.
Beautifully teed up.
to show that we're not actually scripted here. So just to come back to what we were saying, this was chosen by a panel of experts. We didn't really feel this was something that you could expect, sort of retail investors to vote for. But we thought it was actually sort of important thing to include. Now, I think sort of you've probably seen Peter on our shows and probably other sort of investment trust things. Peter is very much a sort of pillar of the investment company space. I mean, I would say if, we had a national treasure for investment companies, Peter would certainly make the grade. He's a lovely guy, but he's a sort of real advocate for the space, and he's been involved with it for probably 40 plus years. Sort of most, I guess, visibly as manager of CT sort of managed portfolio, which obviously is a fund of investment trust. I was saying he's been on our show many times, and I think we will sort of continue to see him around because he's still very, very much engaged. And obviously this board is very well deserved, and we obviously wish him the very best in his retirement.
Yeah, well done, Matt. I think that sums it up. He was just great to talk to.
Yeah,
it's almost like press play.
yeah. He's a great guy. He's just he's excellent. He's excellent.
Cool. Okay, so we've got one more award, I think, which is probably one of the reasons why people are tuned in. So So who won the £5,000 prize? So I'm going to give it away straight away, I think. There we go.
There
Jeff
we go.
Mills.
Jeff
And
Mills.
just to actually prove it's for real, there he is.
With
Slightly
the comedy
surprised, I
check.
think.
Yeah.
Exactly.
Yeah.
Getting the £5,000 check from Ed yesterday. So really well done to him. We met him yesterday. He's a lovely guy. He seems to have most of his portfolio invested in investment companies. We probably could have picked him a sort of a winner, sort of that the more ticked
Yeah,
all
he
of our
ticks all the
boxes. Really.
boxes. It's wonderful.
Yeah, exactly. And obviously he won by predicting who the winners were going to be. Yeah, it's really cool. One of the good things he was saying to me, he just keeps trying to be involved. He reads everything and he watches our shows and we love that. But also he goes to AGMs and stuff as well. And I keep saying to people how you've got this ability to go and talk to managers with investment companies that you don't have with other forms of investing.
It's really important. Yeah,
it's so important.
And so,
Absolutely,
if you have got the time, go and turn up to AGMs, go and listen to people. Because even if you don't like them, even if you don't agree with them, you just get a different insight into stuff, and just sort of press the flesh, actually meet the chairman, talk to them if you're upset, or all that sort of stuff that you can do with investment companies that you can't do with other stuff. It's really quite important.
He was saying how insightful he finds that actually going along and talking to people at AGMs, because invariably there is a sort of presentation, and it's certainly the one time of year that you as a shareholder are going to get all of the board and the manager in the room, and you can hold their feet to the fire effectively.
Exactly. We probably should have explained that to Ed on the other side. For those who didn't know.
Well, he signed the check if you look at the bottom.
Exactly. Yeah,
and I should say, Jeff,
giving away £5,000.
Jeff did assure us that he will be investing the 5,000 in investment trusts as well. Which is,
very
good to hear.
Okie dokie. We are done. So thank you very much to my fellow panelists.
Thanks a lot, guys.
Yeah, all very interesting. I hope you found that useful. And we will be back next week. And actually, because Peter's retired, we've got the new manager of the CT Global Manager Portfolio coming to talk to us. So we find out whether they're going to do anything differently. But that's going to be quite an interesting one to do. So I'll see you next week. And in the meantime, have a good weekend.